Awesome, great. I think we're good to start. So, hi everyone, good evening, and thank you so much for joining this session together with WaterBridge and TiE Bangalore. As you know, we're doing a series of investor showcases across 4 weeks, and today we have an amazing group of five VCs that will spend the next 60 minutes with each of you, taking questions, sharing what their sectors of focus are, what's currently exciting them, keeping them busy, and also sharing some amazing recent portfolio investments as well. So thank you so much for all of you who are joining. Feel free to start punching in your questions into the chat box. And once we do a round of introductions, we'll quickly start addressing as many questions as we have. As you know, the topic for today was, should you partner a generalist VC or a specialist VC, and what really is the value add construct? Every VC out there claims to add value beyond capital. So we thought we'll deconstruct that a little for you. So we've got a eclectic mix of folks like WaterBridge and Adith at Gemba, who have a slightly broader investment thesis, do consumer, do B2B. And then we have Enzia, we have Karuna, who's one of the founding partners of Enzia. We have Harsh, who's a founder turned VC, and they focus on B2B. He's part of SeasonTwo. And then we have Harsha from Inflexor, who's again a deep tech B2B India focused VC. So a great mix of folks today, and excited to get going on the debate. And by the way, just in case you're wondering, how did we put this group together? It's not a random group chosen out of thin air. And what unites all of us is, in fact, the Fast Forward Seed program, and I guess our like-minded focus in the way we invest. So whether you're a generalist or sector focused, I think it's fair to say that we're all thesis driven, and each of us play to our strengths. Whether we are operators turned VC, whether we're professional fund managers, or if you're founder turned VCs. So it's the Fast Forward Seed program that really unites us, and you will know. And at the end of 60 minutes, I'm sure you'll all be equally excited about what brought this group together. Of course, if you would like to be part of Fast Forward and apply to Fast Forward, head to our website and fill in an application. You'll actually get to pitch live to one of us. So I think I'll start with Adith, because apart from our joint, generalist hat that we're putting on for today, we also share, a common love for Japan. And in fact, not many people may know this, but Gemba actually means, real value add, and that very core, center of an organization. So Adith, would love to hear a little bit about yourself, how you started Gemba and what your areas of focus are, and then we'll quickly go around the table. So over to you, Adith.
Sure. So let me talk about first Gemba Capital and briefly about myself and how Gemba Capital was shaped. So we basically invest in seed and pre-seed rounds. Our typical check size is around 100K. We invest in consumer tech and SaaS companies, which makes us the generalist, which Anjali was talking about, because consumer tech could be across fintech or edtech or agri-tech for that matter. And on the SaaS side, it could be a vertical SaaS company or horizontal SaaS company. We started investing around 3.5 years back. Our portfolio is now almost 28 companies. You all can obviously visit the website and check the portfolio. Some of the names would be like a Plum Insurance, a Sleepy Cat, ClickPost. These are some of the Bima Pay. These are some of the companies which we've invested in. And I think that's about Gemba Capital. And I'll keep it short so that we have enough time for Q&A, and I think others can also follow. In terms of my background, before Gemba Capital, I come from a private equity background. I've done larger transactions in the mid-market side, been on board of large companies, taken companies public. So I come from that background. I've been an entrepreneur as well, so I understand the operating side and can put myself in the entrepreneur's shoes. In the QSR space, I ran a brand for 5 years. So more or less a combination of these two things, what I've been doing all my life, is what is the result into culminating into Gemba Capital, which I started around 3 years back. So this is actually my second entrepreneurial venture, I could say. Yeah, happy to have this chat, and thank you for inviting me, Anjali, and would be glad to participate and add value.
Awesome. Thanks for that, Adith. And we'll circle back when we do a little bit of Q&A to understand each of us better. I'm just going to go in the order in which folks appear on my screen. So Karuna, you're next. You co-founded Enzia last year. Another common thing that binds all of us is that we're all emerging managers. Take us through that journey. And many founders don't understand that, VCs are founders too. And we are full stack VCs, as I always like to call ourselves. So take us through the Enzia journey and tell us a little bit about yourself as well. Yeah.
Thank you, Anjali, and I can't agree more. I think my empathy for founders has gone up significantly, having been on the startup journey myself with Enzia Ventures. So I co-founded Enzia Ventures, which is focusing on investing in early stage companies in the health tech, environment tech, and ed tech spaces. At Enzia, our approach is to go deep in the sectors that we invest in and build a thesis on what we like in various segments, what we don't like. What that does is, one, it makes us more efficient in terms of our own ability to respond to, react to pitches that we see. Also, what it does is it has helped us build a network of people. For example, in healthcare, we have network of doctors, we have network of pharma company professionals, we have a network of hospital promoters, etc., which then helps us open the right networks for our companies when and how they need that. Prior to Enzia, I was heading Acumen's India investing. Acumen is a global impact investing fund. I was also heading their healthcare investing globally. And I think my time at Acumen helped me understand that I wanted to go deep into sectors and not be investing across multiple sectors. Just makes me more nimble, helps me take more riskier bets, so to say, or bets which are defining the sector. Also, the ability to go in early is something that I thought was very useful. That's what then led to creation of Enzia. Prior to Acumen, I have worked on large transactions across private equity and M&A in Aditya Birla Group in Milestone. And I think each of my roles have taught me that it's very important to understand the person you back and back the right person. To give as much importance to execution, if not more, as to strategy, and to back people who are resilient, who can come back every day and go on with the job. And I think that's what we do at Enzia. I think we like to celebrate small wins as much as we celebrate the so-called big milestones. And I think as an investor, we see our job as being there for the entrepreneurs in their journey, being their cheerleaders, being their strategic advisors, even being their fin guys, whatever they need us to be at the right time. So yeah, that's about us.
Awesome. Good to know. And like I said, we'll come back to probe a little more about that journey. Harsha, you're next. Inflexor has a deep tech focus, so would love to know a little bit more. And congrats on Fund 2 and your most recent investment, Le Shifu, was hit the press this week. So excited to hear your journey.
Okay, thanks, Anjali. We've recently completed a couple of other investments as well. So Inflexor, we are early stage technology focused investors. When we say we look at technology as a horizontal. We don't look at it as a vertical, as a sector. We look at it as anything which has a strong IP driven focus on the business model or addressing a product with a strong IP is what we look at technology. We are pretty much sector agnostic that way. Right from investing in health tech to cybersecurity to clean energy, I think across the sector, as long as there's a strong technology play, we look at them. In terms of the fund, this is our Inflexor's second fund. The first fund was called Parampara and we rebranded as Inflexor because we wanted to launch a larger fund. From the first fund, we've made 12 investments, exited 2. that's what we don't like to look at when we say about technology is the technology enablers business model. So things like, making online available, offline products being available online, etc., where technology is just a small enabler to the traditional business model, or like a marketplace. We wouldn't call it as technology play, and that's why we don't look at such kind of business models. The second fund, this fund we've set up in last year, 2020. Fundraising in COVID times has been difficult, but we're looking to do final close by maybe end of this quarter or something. From this fund, so far we've made 3 investments. One has been in a semiconductor space. Second has been in the Shifu, Play Shifu, which is into AR, VR. Third investment, our recent investment, which hit the press yesterday, is in media tech, which is, basically trying to convert, on a live streaming basis, trying to translate into different languages. There's a platform wherein you can upload your video and it translates into different languages. So that's been about us. The fund, I'm a principal here, have been associated with the fund for last, from the founding times for the first fund. About myself, I am a chartered accountant by qualification. Worked for 7-8 years in the financial advisory space. Went on to do my MBA, and then I realized I wanted to do something in education, alternative education. So I went on to train as a Steiner trained teacher, which is an alternative pedagogy for education. Realized doesn't work. My work in classrooms is very limited, and I can't add much value there. And then that's how I decided to join venture fund Parampara. So it's been an interesting journey so far. Yeah.
Awesome. Yep. Good to see that everyone's had a founding stint. And Harsha, you're also a founder and a VC. Would love to hear a little bit more about SeasonTwo and your B2B focus as well. You're on mute. Just hold. Yep.
That works.
Yeah.
Thanks, Anjali. Thanks for the introduction and for the opportunity. I'll introduce Season2 first. Season2 is a $100 million fund. We just did our first close a few days back. We've already made around 11 investments in the B2B space. We are super focused on retail, e-commerce, backend of e-commerce, which is warehousing, logistics, supply chain logistics. That's one big area of focus for us. Then we have healthcare, where we're focused on basically anything that enables providers to access the patients better, and also as a bridge between healthcare and fintech, the whole insurtech play, where we are focusing on how insurance processes, while the front end of insurance has largely become digital, but there's a huge transformation that's looming in the back end of insurance in terms of claims processing, reimbursements, the whole process, which is right now dominated by TPAs. Then we're looking at the whole fintech play. In fintech, our focus is on back end of banking. We are focusing on how banks are transforming themselves digitally, not just on the front end, but even in the back end. Core banking operations, all the way from supply chain finance to trade finance, to even as simple as how banks have to transition their processes when they when they transition from LIBOR to SOFR. All these are the areas of interest for us. As I said, we made 11 investments till now in the past 1 year. Out of these investments, the ones that I would like to call out is a flexible warehousing investment that we've done. We made this investment close to 9 months back, and now he is part of the vaccine supply chain. He scaled up from something like $20,000 a month to something like $1 million a month of revenues. Huge potential, especially in terms of how e-commerce supply chains are transforming, how vaccine supply chains are transforming in India. Then the other one is Uvic, which is a contactless POS, the first contactless POS, which is rupee certified in India. Already working with something like 1 million merchants and more partnerships in the pipeline. And as we speak, we're closing out 3 more investments. My own background, as I said, I'm a founder, a B2C founder. I have my own kids food and nutrition brand, which is what I devote my time to. SeasonTwo is a fund based out of the US. So most of our work is covered in terms of accelerating the startups to go from India to the US or from India to the Middle East. So our focus is taking enterprising founders and fantastic ideas, try and mold them for Fortune 500, Fortune 1000 customers in the US. So we have an accelerator called Mclaren Strategic Ventures, which functions out of the US, which kind of takes companies not only from SeasonTwo, but also from other funds where there's a fit and accelerates them for the US markets. So that's something unique about our model where we are not just a fund, but we are also an accelerator with real people who can actually act on your behalf in the US and do business development for you. My own background, as I said, I'm an entrepreneur. I have my own B2C startup. So whenever I'm striking a deal on this side, I know exactly what the founders on the other side are thinking and talking like. I'm MBA from IIM Calcutta, worked in Tata for 7 years. First 3 years in doing strategy and life sciences, entry strategy for life sciences and healthcare for the Tata Group. Then I set up, incubated, and ran the Tata Health business, which I scaled from 0 to around $10 million. And then I got bored and said, I want to do something of my own and came out.
Awesome. Amazing story, and good to know about the Mclaren value add construct as well. That I think a common link, and I don't know if founders are making note, is that everybody here has just closed a fund this year or last, which means there's significant dry powder in this room and this Zoom call itself. So I hope folks will reach out. Just to circle back, I think one of the core tenets, even of the Fast Forward program, in fact, has just been fairness and transparency and just literally fast forward and just respect founders' time and turn around things quickly. And Adith, we've spoken about this before, and I've noticed that you do this as well. And in fact, on your blog, you're not kind of afraid to state that the number of investments you make every year and the number of ones that have had to kind of shut down as well each year. It's very unique to a fund, and most funds kind of hesitate or shy away from mentioning those, right? You've also written and spoken often about entry valuation and how there's no point fussing around the valuation of a company at an early stage, and if you find a great missionary founder, you should close the deal quickly. But we'd love to understand a little bit more about these two aspects and the fact that, like I said, you don't mind putting it out there as to what's worked well and what's not worked well as well.
Yeah, absolutely. I just feel that a lot of these founders are now building in public, and so should us VCs as well share as much information as possible, so that founders are aware about how a VC functions at different stages, right? And different types of VCs have different styles of functioning. So if you're talking to a pre-seed, seed kind of a VC, the style of investing, the speed at which decisions are taken, and the number of transactions.
Voice is a bit low, Adith. Could you speak a bit louder?
Yeah, is it better now? Is it better?
Yes.
Yeah, slightly better.
Karuna is nodding her head though, yeah.
Okay. Yeah. So so I was mentioning that it's important for all the founders to be aware of how every VC functions, and it's our role and our job to put it out there so that expectations are set. And every VC has a different style of functioning, right? If you're talking to a pre-seed, seed VC, decisions will be taken quickly. There'll be much more shots at the goal which will be taken because we don't really have too much of data, right, to sit and analyze it. The product itself in certain cases is not there. It's a pre-product deal also which we have closed, right? So you need to be very well aware about how, on what basis are you taking these decisions, and it's more or less the founders. I think I need to just put on my earphones or something because a lot of people are saying that not able to hear me. Give me one moment. Okay, is this better? Okay, cool. Yeah. So the point is, coming to the second point about valuations, right? In early stage, it's basically a negotiating discussion across the table in terms of why you need this much money, and the value and the dilutions are pretty much kind of decided, right? And if the nature of the startup is such that that kind of a funds is required, the valuation is set. Why I would not fuss so much about the valuation is because as it is, we are looking at much larger outcomes, right? The stage at which we are entering in. It's better to invest at a slightly higher valuation rather than miss out a company which could eventually still give us 100x. That loss is much higher. That's a 100x loss for us. And if we lose a particular deal, just a 1x loss for us. It's like it's criminal to miss the next Google, right? Even if it's the most expensive transaction if we got, right? So that's why probably the case would be different in series A, B, C, when you have a lot of data points, where you have a lot of science behind it, and you know that your multiples are going to be limited, and you need to sell it to the next give an exit to the next investor. But in our cases, really valuation is the last thing we look at it. If we really like the founders, the space, the product which they're building, and their ability to build it, and if there is a founder market fit, we'll go ahead with it. I hope I've answered both of your
Yeah,
questions.
no, for sure. And I'll use that as a segue to go to, Harsha, because Inflexor is deep tech. And one of the questions that, we also keep getting about deep tech is that, IP protection in India is still in infancy. And many times you're also an early stage fund. So what Adith was saying about not having too many business metrics in a B2C case. But with a deep tech focus, it must be even harder for you, firstly, to identify if founders are in this R&D trap where they're like continuously investing in R&D but not able to get early PMF, or how do you even judge early MVP success, etc. And second, around the IP bit. So just lend some color to the evaluation process for deep tech startups, especially the India focused ones. Yeah.
Okay, so Anjali, I'll take your second question first in terms of the IP protection around. I think what you mentioned, IP protection is difficult in India, where the IP laws are not as stringent, and the cost of filing IPs is very high. So an early stage startup does not like to file an IP patenting, and they don't like to do that, or they don't have the resources to do that, for that matter. So when we look at that, what we look at when we say there has to be a strong IP, see, every technology at some point is copyable. It is not that you cannot replicate that technology. What we look at in terms of protection of the IP is how much time it takes to replicate. So as long as there's a moat of say 24 months or 36 months, where the technology replication of the technology can happen after that time period, even if there is no patenting or anything, we look at it as a protection to the IP for that period. Now coming to your first question, where about companies being into R&D. I think for us, when we evaluate companies, it is very important that what is the founder's mindset towards research and productization of the ultimate productization. If the founder's mindset is too much into research, and ultimately they want to, we don't want somebody to be a research R&D company. We want them to have products ready and where they can productize, monetize. And I think there the founders' ideas is what we evaluate more. So we see that, okay, there is a product market fit, there is a need for this kind of product, but does the founder think that he wants to address that market need? Or is he more focused on, fine tuning the product, doing more research rather than getting out at least an MVP and then fine tuning it? So I think that is where we see both. Look at how the founders want to approach the business, as well as what is the technology around.
Yeah.
Because ultimately, if it becomes a R&D project, then then scaling up the company becomes issues.
Yep, I think it's one of the reasons why you prefer seeing early revenue when deals come to you and when founders approach you rather than pre-revenue companies.
So we have done pre-revenue companies. It's not that we don't, but we typically prefer that at least they have done POC revenues. At least there is some validation that okay, there is fitment and there is need for that product in the market.
Yeah. And Harshman, as part of season 2, you get a very good vantage point from the US, right? And we do see a lot of Me Too kind of deals coming up in India. And I know we've had this conversation before about how you put founders in front of CXOs of market leading enterprise companies and get very quick feedback. But if we were a fly on the wall in those meetings and rooms, just share some insights on what's the typical, if you can just generalize the feedback or give us the top 2-3 things that you would advise India founders heading to the US.
Harsha, you're on mute.
You just need to unmute, yeah.
So we've done this with around 24, 25 companies which have progressed to a decision point where we have taken them to potential customers, including our advisors who've been CXOs of companies like Walmart, Santander Bank, etc. So the feedback that we get, what we have seen in these conversations is, sitting out of India, we have a very, the success of some of the SaaS companies, what it's done is, we tend to generalize that, somebody is a fresh desk or somebody is a Zoho. We just need to follow the same model and we'll succeed in the US. But when it comes into specific use cases, which like a bank or like, let's say JP Morgan or a Morgan Stanley or even a regional bank in the US is looking for, what happens is when we take them from India to the US, we find competition. And competition that in some cases, these startups have never seen or heard of. It's a surprise for them. Okay, have you developed this in-house? Some of these companies have very strong technology development. So like the likes of JP Morgan or Walmart, for example, have Walmart Labs, which does a lot of serious work. So when we put them in front of CXOs, sometimes, Indian companies, while everyone in the US is polite and appreciative of the fact that somebody from India has done this, what ends up happening is always inevitably some delta in terms of the product curve compared to the US. But it's solvable. What we've heard in many cases is yes, one, the cost advantage is enormous, advantages to the Indian startup. And in most cases, because Indian founders are willing to kind of work together with the customers, US customers, to kind of come up with a MVP or a product which really works for them, then there is that resistance gets broken. And we have had instances of 2 or 3 startups that we are working with accelerating where these conversations have progressed to a potential revenue stage. So one is the maturity of the product itself in terms of the US competition, global competition, because the moment you're playing global SaaS, you're going to be compared against global peers. What works in a Kirana shop in India may not necessarily work in a Kirana store in, let's say, or a neighborhood store in the US or even Latin America. Second thing, what we have seen is, and this is something we're trying to work very closely with the founders on is, we tend to talk about the product first, what we are offering first. We don't approach it from the lens of the customer. Most US startups or a lot of the US founders actually do a lot of homework before they present to a CXO of a large Fortune company. They actually go to the extent of finding out what are the major problems that this customer is facing, what are the major pain points, what are the problems that we could solve. So when they go into a meeting, there's a lot more preparation done. And a lot of this is because they have US presence, they have the ecosystem connect, right? So what happens inevitably when the Indian founder goes is they start talking about their product. 80% of the cases they start talking about the product, and then then the conversation evolves. Whereas the US founders talk of the problem solution first and then come on to how they're solving it. So that's another gap that we have seen with some of the startups that we have taken to a level where they have interacted with CXOs.
No, very valid point on the lack of customer first thinking, if I may. And just during a pitch to we see as well, one of the top things we always look for, any VC look for, is like, what are those unique customer insights and what primary research have you done to say that this is a top of mind problem that you're solving for the consumer? And I think I'll move this to Karuna. As we look at the Enzia portfolio, one thing that struck me was exactly your focus on climate, your focus on women's health, for example. I think women's health is one of those good examples where 50% of consumers out there are women, but yet there's a massive lack of women's focused healthcare platforms. Would be good to just go give us a behind the scenes look of how you evaluated some of your bets in women's health, and also a little bit more about your focus on climate and environment, because that is very unique in the Indian VC space as well.
Sure. So on women's health, I think, as I mentioned, we are very sector focused, Anjali. And so we generally come with, start with building out our own thesis on what will work in the segment. So we are more proactive. So we were the ones who said, okay, we think women's health is promising. It is seeing a lot of interest globally. It should be getting its due share in India as well. And so we started looking at the market. In women's health specifically, what we saw was a lot of companies were still hesitant to approach the customer with a full stack solution, and were figuring out hacks to approach the solution. Maybe I'll sell something which the customer is willing to buy today, right? So our approach to this problem was, look at what the customer needs today, and what are the solutions out there? Is there a match between the two? If not, what is it that you want to give to the customer? Is this women ready to be a customer? We saw from our data that yes, women were willing to transact online. Women were actually one of the early adopters of health tech, online digital health solutions. So they were definitely ready to access healthcare solutions. The need was to provide them a full stack solution, provide them solutions that work, right? And I see that there's a explosion in women's health businesses in the last 1 year, right? We are seeing at least a business week, and they're all focused on PCOD. Now, see, the problem is you have to come at it from a solution mindset. What exactly do you need to do to solve PCOD? Is it clinical? Is it holistic? Is it giving them D2C products? And maybe it's all of these, but you have to give them a solution that works, rather than saying, oh, I'll do nutrition for PCOD and I'll do fitness for PCOD. That's not going to create a sustainable business in the long term. So I think our approach has been very simple. We're looking at what it will take to solve the customer pain point. First, is there a real pain point? In most cases, I struggle to find the real pain point that the companies are addressing, but our approach is simple. Is there a real pain point? And are companies addressing it in the right fashion? So yeah, that's where we're at. Environment, I think it's a sector which we think will gain a lot of steam in a few years. You're already seeing environment tech, and I, in Acumen, invested in the early phase of environment tech, as you call it, the hybrid mini grids, biomass based mini grids, all of that. So I've seen the first phase of environment, the failures, the challenges there. I think the current phase of environment tech is a lot more customer focused. It's not regulation dependent. Oh, government will give us subsidy and we'll be on par with coal thermal energy, right? This is a lot more customer focused, lot more solution oriented companies that we're seeing. Although I think in India, it's still difficult to see enough pipeline in the space, but we're excited. We've been doing a deep dive in the plant protein space. We are excited about all of the action that we are seeing. And we do see there's a potential for companies to go global from India. India, the market is very small right now for plant protein.
Great. Yeah. And I think one thing that we've been seeing, even, you mentioned about femtech, if I may, I think hashtag femtech has been trending for a while now. But another space that we're seeing is extracurricular edtech, and I think we're all partners at Fast Forward, and 17% is the exact number, which is the number of applications that are coming in specifically in that space. And if I throw this question at Adith, I'm sure he'll agree and say that he's probably seeing many, many more that come to him. But just a quick question to founders from a founder perspective. You mentioned femtech being super crowded. We're seeing education, extracurricular being super crowded. But when a founder kind of pitches to VCs, what are the 3-4 things they need to keep in mind? As VCs, we're kind of privileged to have that macro view to see where most deals are congregating towards in a given season. But as founders, what would you kind of say, like what should be the standout things in your pitch deck, especially knowing that you're getting into a hyper competitive space?
So,
Adith, your video, Adith, your video is off, so we hope you're there and you'll be able to take this question for us. Or Karuna, just go ahead. We'll wait for Adith to join back. Yeah.
So in my mind, as I said, there is some amount of fatigue that sets in when you see the 30th or the 31st company in this space. But honestly, as I mentioned earlier, right, strategy is like a small part of what will lead to eventual success. So for us, I think what we are looking at is how you approaching the problem. What is the defensible advantage that you're building? And how will you out execute others? And I think having the right team, the right approach to the problem is important, and doesn't matter even if you're not targeting a large white space out there and there are 5 people ahead of you.
Yeah, good one. And I think just starting to pick up some of the chatter in the chat box, and one good question which I think both the Harshas will be super competent to answer is around IP. Love the question. The question is actually, should you go the Tesla way and make all your patents public, or would you actually recommend an advice to founders that they file IP and they get patents across geographies early on? And Harsha, I'll allow you to take that.
This is kind of interesting. I mean, it is the typical MBA answer would be it depends. But I think what is important is that whether you file a patent or not, what's important is how defensible is your technology. As long as you have strong technology moat, as long as you think that you have developed something with the fitment idea, you understand the market, and it is not easy to replicate. I think it really does not matter whether you file a patent in India or whether you file a patent in US or you want to make it public. Because ultimately what does matter is that how soon can you approach the market with the technology. Because like Apple started with the touchscreen, they wanted to patent it. Eventually, everybody got it. It's not that it's not replicable. So it's going to be replicated. But what matters is today, even now, Apple's touchscreen is considered to be, it's a premium product. So I think it's important for a founder to make sure that what they are doing, what they're working on is they're focused to make the product better. They're not focused on, getting it patented, get more patents ready. It's not going to work. What matters is how good is your product, how fast can you approach the market, how fast you can capture the market.
Yeah, no, well said. And Harsh, I'm not sure if you want to add something to that.
Yeah, so I'll just add one more thing to this. So we have come across situations where we have had a very strong tech founder who believes there's some real uniqueness to the product that he's developed. Where we have encouraged, IP protection is where we think there's a defensible advantage, like she mentioned, right? It has to be a defensible advantage, not a minor process tweak or a minor technology tweak, which is not defensible over a period of time. But really the secret sauce is the business itself. It's how quickly, so the real test of any technology is whether it's making a difference to your consumers' lives. So if you can't introduce a product, whether it's B2B or B2C, put it in the market and see whether the consumers are finding and finding some benefit from it, it really doesn't matter whether you protect it with a patent or not. There are thousands of fantastic technologies coming out of universities getting patented, but don't hit the markets. So the real test for us as investors is one, first check, okay, there's some IP. If the IP is there, is it defensible and differentiated? Third, what is the commercialization potential of this IP? If there's no commercialization potential, it really doesn't matter.
Yep. And Adith, are you back? I think I do see. Yep. Excellent. All right. Just put this question your way, since you're the B2C expert in the house. And I think one of the questions we're getting is, considering early stage, that many a time these might be pre-revenue companies and lack of business metrics to really evaluate. Help founders understand what do you really mean by founder market fit, and typically, do you believe that all founders should have necessarily either experienced the problem themselves before they turn founder, or broadly help them understand what founder market fit is, and what would you evaluate in terms of founding team backgrounds?
Sure. See, obviously, it's a long answer, so I would not give the long version. You can visit my website, and there's a blog section in Gemba Capital website where I've kind of detailed out what, according to we think what a founder market fit looks like. But I'll just give you some broad ideas, right? Like, in the sense, it's not necessary that you have faced that problem in the past, right? What is more important is, do you have an insight into your consumer to which you are kind of addressing, right? If you have some unique insights, that's where that's the start of your journey, whether you should be making this product or not. It could be solving a problem, it could be making something more convenient, more cheaper, and then are you the right people to build that kind of a business, right? And that's where the founder market fit comes in. And just by experience in that particular sector does not mean that you are the right person to build that kind of a business, right? It could be various other attributes, right? Like, for example, if you're building something which has a higher gestation period, something what probably Harsha is looking at in the deep tech space, you would want a founder with a certain maturity. You would want a founder to have high threshold limits to kind of stay longer in the game and think very long term, right? Whereas if you are catering to TG, which is like 18 to 22, 25-year-old, then are you the kind of guy who gets insights, who gets along, right, and who understands the customers much better? Probably a 50 or 45-year-old would probably not be the right founder market fit for that. So there is no, again, right or wrong answer, but we as investors try to assess that, because that's one of the things which we have to take that decision at the very early stages in case of a pre-revenue company, right? So that's why very important for us.
Awesome, great. And just to kind of break the format a little, one thing we like to do is do a quick rapid fire for a few questions. So ask a question, we'll do a quick round of monosyllabic or maybe 2-word kind of responses. So I'll just start firing away some common questions, also picking from the chat box. I think the first question is most overused words in a pitch deck, and I'll go with Karuna first.
ML and AI right now.
Damn, you took mine, so I'll have to think of something else. Harsha, over to you.
Blockchain is the other one.
Harshvardhan.
Concur with Karuna.
Adith.
I think AI. I think nowadays is the most used one. Right?
So AI ML is the unanimous winner here. So I think the next one is sector that you're most fatigued with, other than extracurricular edtech. I'm just making it a little harder.
I would go first. The fintech sector, where everybody wants to address the underserved market with a alternative evaluation method.
I think lending for me.
Yeah.
I don't
Karuna.
I have to keep looking for the right companies.
Harshvardhan.
Health tech virtual consultations.
Health tech virtual consultations. Yes, that's a good one. What's the next one is, what's the largest ever TAM that you've seen on a pitch deck? if you could put a dollar billion value to it, possibly?
So I don't remember a number for sure, but I've seen some crazy numbers for sure running into $3-digit billion and stuff like that.
Yeah. I would agree with Adith. I mean, the time some people put crazy numbers on that.
No, we look at banking tech, right? So we have come across 50-60 billion dollars at times. So people want to transform banking end to end. So we've seen 50-60 billion dollars there.
Yep, I think close to three digits in some sectors, but we're saying that fintech again is the lead on this one, which with the possibly the largest TAM. The next one is, what's the largest founding team size that we've seen? We often pick on single and sole founders, but how
4.
large of a founding teams that have you seen? It like delivery style? Do you have 8, 9 of them?
No, I've seen 4 maximum.
I've seen 7.
6, 7.
Yeah, I've seen 5.
Yeah.
Okay, and finally, I have to ask this. What percentage of women founders do you see pitching to you?
In terms of percentage, probably it would be single-digit percentages.
Maximum 10%.
Yeah, 10-15% max. Women's health, we saw a little more.
I think the trend's been changing in the last 6-8 months. We see more women founders pitching, but yeah,
Still small.
So
still too small.
Anjali, we have a mandate to find one of my team members. I don't know if she's listening to it. We have a mandate to find more women founders, but still we are struggling around 10 to 15% max.
Well, I hope we have 140 people here, 141 just now. So I hope if any of you are women founders, please head to the SeasonTwo website and hit up Harshvardhan right away. Also, by the way, just a fun fact, since Harsh mentioned it, at Fast Forward, if you are a female founder applying, we are in fact guaranteeing you a direct pitch to partners at VC firms. So you will get to meet one of Karuna, myself, Harsha. We also have Bhargavi from Java, who's part of this alliance. So yes, I think all of us agree that we're not seeing enough and would love to hear from more women founders out there. I think the last one is the most, the most cliched question that you get as an investor.
How soon can you give the check? I think that's something which every founder wants to know the first thing in the first meeting.
True.
Can you repeat that, Anjali? What was the question?
The most cliched question that you get from founders.
Oh, question.
What is the value add you bring to the table?
Yes, let's hope that we've genuinely made an effort to answer that today.
So yeah,
awesome. I'm just kidding.
Yeah,
how
please.
to close the process. That's the most common one, I guess.
Yeah, I think that's the most common one. What's the process? How long does it
Yeah.
take?
The other one nowadays, are you comfortable co-investing?
Yes, we do get, I think, I don't know if you have a view, of any of you have a view on this in terms of, co-investing, not being the lead, etc. But since you raised that, would be happy to kind of take a quick point of view from each of you on what your preference is in terms of where you want to be on the cap table.
Yeah, in fact, let me talk about Gemba Capital. We are a very, very lean team, and we are not a large fund. So for us, we are completely fine with co-investments, right? For the simple reason is, we probably spend that time and save that time and spend that time more with our portfolio founders and helping them out and adding value, rather than spending the same amount of time leading the transaction. Because of the lean team which we have as a micro VC fund, right? So, and I think it's a ecosystem where co-investments are accepted, and everyone's open about it, even the founders and even the other investors. So I think it's overall good for the ecosystem. The founders are able to close their rounds faster, once they have a lead, and the balance can be chipped in by the co-investors. So I think it's perfectly good for the ecosystem to have people open about co-investing and not just want to lead all the transactions.
I would just add to Adith's view. I think for us also the idea is pretty much similar, where we are open to lead as well as co-invest. And what we also see is that when we have like 2 or 3 different VC funds coming in, I think what also adds is sometimes the founders, at least in one of our portfolio companies, we've seen that they selected 2 or 3 different VC funds because these 3 VC funds got 3 different value adds for them. So I think they wanted to keep all 3 of them on the cap table.
So in our case, what we prefer, we've had a healthy mix till now. So I think 30% of our investments till now are lead and 70% are co-invests. Depends on the state. So we typically put in anywhere between $500,000 to 1.5 to we even go up to 3 in some cases. So it depends on the stage and what the startup is really looking for, and also a conviction with the startup itself. So it's flexible for us at this stage.
We are comfortable with co-investing. In fact, we like co-investing, while we are also happy to lead deals because we invest very early stage, and given the stage that we're investing it, there's a lot of heavy lifting that needs to be done. So we like having investors who can share the load.
I think that's one of the reasons we all came together for Fast Forward as well. I think it's fair to say we're all open-minded and excited about working with each other. I also always tell to founders that done is better than perfect. So if you do have a couple of investors you like and they've given you a term sheet, it's faster and better and easier to close that one rather than keep trying to have the wild goose chase of finding that elusive perfect founder match, a founder-funder match. We're going to take a few more questions, cognizant of time, and I'm bundling a lot of them. Karuna, there's one specific to you about just mental health care and mental wellness. And, are you seeing any exciting deals? Do you have a point of view on the space, especially India-focused ones where there's considerable stigma, around the topic and the sector?
I think curative mental health, we don't have the customer readiness and paying capacity is my view, but preventive mental health, whether it be meditation, mindfulness, etc., I think we're seeing a lot of interest, and that's the right place to start. So yeah, pretty excited about preventive mental health. Curative mental health, I think for me, it's wait for the right opportunity to come along.
Yeah. No, good one. I think we have one on fintech. Any of you could raise your hands to take that one, but it's a good question around, especially if you're a lending platform or a payments platform, do VCs really need you to have a regulatory license, or are you comfortable with aggregation platforms just working on the back of somebody else's payments bank or NBFC lending license?
Yeah, I think it really depends upon what your business model is. Like in certain cases on the lending side, you do not have, no one's expecting to have an NBFC license at day 0. So you will be probably doing an FLDG arrangement with some of the other NBFCs and using their books to lend, right? So it is case to case dependent, but as long as it's regulatory safe, what you're doing, I don't think so that should be an issue, especially on the early stages.
Thanks for that, Adith. There's another one on valuation. It's more generic in terms of, 2 questions. So I'll break them up into separate questions. One is what typically is seed and Series A, pre-Series A dilution at the moment, and secondly, how necessary are ESOP pools, prior to investors coming on the cap table?
Yeah. You want me to take it up?
Sure, please go ahead. Yeah.
So
and just raise your hands, guys, and I'll just give the question to whoever raises. Yeah.
Okay. Yeah. So I think 15
please go ahead,
15 to 20% is what we are seeing normal dilution at the seed levels. And the second question, what was the second question?
ESOP. Is ESOP a must? And if yes, broadly, what range are you seeing?
So for us, ESOPs is a must. And if it's not inbuilt, obviously it's taken as a condition subsequent and formed. A good number is always debatable. 10% is what we've seen on an average as the ESOP pool. In certain cases where let's say there is a single founder, and I would recommend to go up to 15% as well, because you will need to have those kind of people with a complementary skill sets at senior levels. And in certain cases where there are 2 3 co-founders taking care of growth, product, marketing, and things like that, probably you can manage with a 6 7%, 8%, less than 10% ESOP pool as well.
Yep, absolutely. Even at Fast Forward, we are currently, asking for a 10% ESOP pool before we come in, but highly recommended. Like Adith said, if you're a single founder, better to have it slightly larger. Karuna, another one at you. You seem to be the popular one with your impact investing background. We are getting a few questions. I'll bundle them all into a single master question around, if you are an impact focused founder, how do you really kind of prove that the market is large, scalable, but most importantly, that there is a large commercial outcome at the end of it? And some of the examples I'm seeing is around organic foods, for example, or ethical sourcing, making your supply chain transparent via blockchain. And these are broadly what people are asking.
So yeah, as far as even if you're focused on impact, at the end of the day, you have to ensure commercial viability of your enterprise. And there are two ways to look at impact. One is, Anjali, as you mentioned, where you're focused on making the value chain more resilient, sustainable, etc. In those cases, I think you're going to be evaluated as any other B2B startup would be. And what people will look for is, are the end customers that you are selling to, are they ready to spend that extra dollar on impact? But sometimes it's also a question of, when I look at plant protein, I'm like, guys, you have to be on par with the options available today. You can't sell something which is 3x more expensive and expect people to pay, at least in India, for better environment impact, right? So it's a question of, is the market willing to pay a premium for your impact? In most cases, the answer is going to be no, and you have to be prepared for that. In some cases, the market is going to be willing to pay a premium. That is in case of B2B customers. In B2C impact enterprises, I think proving paying capacity is very important. Market is always large because there's always 90% of India which will fall under the impact customer segment, right? But the question is there a paying capacity? Is there a willingness to pay? And if you can get those two answers sorted, then I think there's something valuable that you're building.
Yep. And I think we have another question around founder market fit, and maybe we could do a roundtable for this on what are the common biases that you're seeing against founders. We spoke about the single founder or the lone founder bias, or are there any unconscious even biases that we're seeing against founders? Age, education pedigree, single versus multiple founding teams, and how do you view it? Maybe we can start with Vardhan.
So in our case, there's no bias. If at all, there's a bias towards getting some diversity going, and plus ensuring that we have people from all backgrounds represented. In fact, we consciously don't look at founder resumes before we look at the presentation deck first and then the founder backgrounds. But we do sense, like sometimes when we talk to other partner funds and all, we see there are some biases, inherent biases, and that comes from the backgrounds. It comes from the educational institutions. It comes from past experiences. But I think more or less what people look for in founders, whether they're single founders, multi-founders, etc., is integrity, ideas, passion, and attitude, right? Rest, other than this, I don't think any of the other things matter.
Yep. And if I could just quickly add to that, I think two more things. Like, I think we have no positive or negative biases, I would say, but just getting fantastic angel folks, and doesn't matter what the ticket of their angel check is, but it could be your boss at a former organization, it could be like a mentor, it could even be friends and family, but getting some angel checks would speak highly of your credibility, and I think that's worth a lot more than educational pedigree, or whether you're a single or a multi member founding team and the like, I would say. Karuna, you wanted to say something, sorry.
No, I was saying that, right? As investors, it's our job to not have biases, right? While founders might be seeing a pattern about people from a certain institute getting funded more than others, I think as VCs, what we're looking for is that credibility, that ability to understand the problem, ability to pivot as and when required, and eventually an ability to work with and build a team. So I don't think we come with biases, or at least we are working hard to prevent any biases from creeping into our decision making.
Yep. And thank you so much. Let's move to quickly in terms of how our ticket size is determined. I think I can answer this on behalf of everyone in terms of specific ticket size. There are many questions around that. I think all of us are early stage, so we all kind of straddle from seed to Series A and do anywhere from as low as a 250, 300K check all the way up to 3 million. And it's kind of quite difficult to give you a specific number to say this is like our sweet spot, and our ticket size depends on multiple factors like where your company is, what stage, what markets are you chasing, is it a high cash burn nature, how are you acquiring your customers? So tough to say, but this is broadly the ticket sizes and the investment checks that this group today cuts. And we have punched in everybody's website, and websites have email addresses, so I encourage each of you to directly reach out to all 5 of us for any specifics, and happy to evaluate. Just moving on as well, I think it's a good question around follow-on capital, and as founders kind of seek to partner with early stage VCs, what are some of the questions that they should be asking VCs, and how do you kind of assess VC founder fit, if I may? One thing I always say is the ability to enable you to raise up rounds, follow-on rounds, and to give follow-on capital to the company. But again, once again, would love to hear each of your views as well.
So Anjali, I think I would totally agree on the first point in terms of when the VC founder fit. When a founder looks at a VC, I think the two things which they primarily look at is, first is the ability to give capital, but the second is how is the personal level of comfort they derive from the VC team. We've had in our, I'm sure all of us have gone through that, where we compete on deals, and irrespective of the valuation which you are giving, probably a founder would prefer to have an investment from you which might at a lower valuation, if they see there is alignment on strategic thinking and business focus. So I think that is also important for a founder to look at.
Yep, I'll take the next one. Just a quick thing to the audience. We do have like a hard stop at 5:30, so we'll just request you at 5:15. We kind of stop taking any more questions and use the last 15 minutes to respond. So just quickly do punch in any questions you have. A lot of them are directly messaging me, but would be great if you could just put it in the chat box. It's just easy for me to have all questions in one place. I think again we spoke about founder biases, but we're getting a lot of questions on sector biases. And I know we always give a very standard motherhood statement for this, but obviously everybody seems to be, or the common narrative is for a venture scale business, tech needs to be the common denominator of sorts. But a lot of founders are saying, what if I'm not a tech-led business and I'm more a traditional business, say automotive components, or I'm a food tech, or a food, clean vegetables and fruits kind of a company. So what are the non-tech, more traditional, so-called old economy sectors? Do they have specialist VC funds focused on that, or do they rely on grants? And I don't want to answer the question myself, but I'll pass it on to some of you who can help these founders to the right set of investors.
Yeah, actually, unfortunately or fortunately, most of the investors are looking at tech businesses and tech-enabled businesses. And there is a reason for it, right? That the reason is the outsized returns, the scale, the ability of tech to impact, humans per se. And I think generally the tech returns in the last few decades have been much, much higher, right? So everyone wants to invest in tech businesses. But the non-tech businesses, I think the way to look at it is get money from angels who a lot of times are not looking at the differentiation between tech and non-tech, and also fund traditional businesses. Get into certain investors who have non-tech businesses on their portfolio, or a network who that are also looking at non-tech businesses, and take that initial money from them and then grow it up. And then once you cross that VC space, then on the private equity side, there are so many private equity funds who are doing non-tech businesses, right? And investments in core traditional businesses. The only thing is those are large businesses. So there is a gap clearly at the Series A stage, where a private equity guy, it's too early, and a VC is not looking at it because there is no tech. So you just have to bridge that gap. But on the other two extremes, there is money.
No, well said. And if you're IP-led, especially, we are seeing an incredible number of grants available today to fund your R&D, to fund your early research, initial research. So would encourage you to reach out to a lot of these, both government as well as private sector foundations and grants as well. That's becoming an increasingly important source of funding and capital. I think this is a little bit of I'm not sure who the joke is on, but the question really is, investors seem to only invest in cash negative vis-a-vis cash positive companies. And what do I do if I'm indeed a cash positive, profit making company?
Investors invest only in growth. Let's put it that way, whether cash negative or cash positive.
Cash positive doesn't matter.
Absolutely. I think we've got that one. I think a good question here and slightly longish answer. Harsha, not sure if you want to take this one, but just want to help founders understand typically what is the DD process post term sheet, from basic things like private company registration to what is the kind of SOP or the checklist of sorts that founders need to ensure that their ship is in order before founders can close.
I think the 3-4 main things. One is in terms of internal hygiene for compliances. That is very essential. I think if you set the systems at an early stage, it's easy as you scale up, as the company scales up, it's easy to maintain that consistency on the internal compliances side. So that is one main hygiene. Which we try and put in, even like when we do a seed stage investment, they might not have it. We'll put it as a condition subsequent, but we'd want them to have that. Second is discipline in terms of, reporting, discussion. And it's always better to report anything negative. The sooner the better. Don't wait for the monthly MRM to come in, and then respond and say that, okay, this thing happened last month. Some issue crops up, keep that communication channel open with your investor and communicate faster. I think that's where, for the firefighting also, the investors can help you. So those are the two main points in terms of regular communication. What we want to make sure that when we are doing our DD, etc., that these 2 points are emphasized. I think that's there.
Yeah.
In terms of DD, I think financial legal DD, typically there are checklists and points which usually come into conditions subsequent, because these are early stage companies which will not have most of the systems in place.
Yep, and I think it's fair to say the good thing about getting institutional VCs on your cap table early on is that while we do come with our own set of bells and whistles, I think it kind of sets you up well for further rounds of capital, and also ensures that you have good governance, financial reporting, and MIS frameworks early on, so that as you move forward, and today we are seeing how quickly there's like very little gap between subsequent rounds of funding, right, and just enables you to close rounds faster. And I think the quick takeaway from Harsha's response is just be transparent, say it as it is, and just the earlier you get everything in place, the better for you. And don't look at it as just from this round the diligence is a pain, but this is, if you've decided to get VCs on board, it's fair to say that we will insist on a set of governance frameworks. Yeah. I think there's also a question on portfolio clash, and would love to get both Adith's point of view, since he works very closely with angel syndicates as well as an institutional VC point of view. So I can give this to Harshvardhan, and then Adith, you can also share. And do you take competitive portfolio bets? And is this only direct competition or even indirect bets in terms of, say, Tom, competing or market overlapping, etc.? So do you take competing bets in your portfolio at all?
I'll go first. We don't. We try and make sure it's complementary, not competitive. Unlike a large fund which has the bandwidth and the freedom to actually have competing investments, as a smaller fund, we would put our bets into one in one space rather than trying to have two or three. But we look at adjacencies and complementary business models. That's something we seriously consider.
Yeah, even at our end, we try to avoid exactly competing businesses. There is no point in doing that for us as well. But in terms of indirect competition, so let's say you're going after the same TG in the same space, probably we'll still look at it. But something which is directly kind of competing, we avoid.
Got it. No, sounds good. Just a last couple of questions before we wrap the session up. I think many folks are also asking on convertible instruments, safes versus priced rounds. Karuna, would love to hear from you as to what your preferences are, and we can just again go around the table, and happy to end with what we prefer at WaterBridge here.
So we're seeing a lot of safes in the market right now, convertible notes, etc. We're okay with it, but we'd like the price round to happen within a defined time frame.
Yeah, same is the case with us as well. Would prefer a price round, but convertible rounds are perfectly fine.
I think it's the same with us as well. Our preference is obviously for a priced round, but if it's a smaller round with a defined time frame for the next round, we are okay with convertibles.
We prefer price rounds. Till date, we've avoided convertible notes till date.
Yep, I think likewise, even at WaterBridge, our preference, and in fact, we only do priced rounds. I think as a startup founder, there are enough variables that you need to deal with, and I don't think valuation should be one. So our preference is also priced rounds. But having said that, we do know that there are a lot of convertible and safe note options also available to founders, and I think to each their own, and whatever works best. Goes back to done is better than perfect. So closing a round is important. So go with whatever works best for you. So that's a wrap from our side. Once again, a big thank you to all our investors who took time out, who extended the session by almost 20 minutes. Thank you so much. Karuna from Enzia, Harsha from Inflexor, Harshvardhan from SeasonTwo, Adith from Gemba. We've put all their links on the chat box. Please do head out, reach out to them if you want to connect and learn more. And as I mentioned earlier, we do this every Wednesday from 4 o'clock to 5. So do join us even next week, where you'll meet another bunch of investors as part of the TiE Bangalore Investor Showcase. Thank you so much once again, each of you, for making the time for today and patiently answering all kinds of questions. And I truly hope that this session was beneficial to all. Thank you so much.
Thank you so much.
Thank you. Thanks for having us.
Been a wonderful session of great learning, lots of questions. So thank you, Anjali. You hosted it as always very, very, very nicely, and much appreciation, from